You're about to hear my conversation with our two CIOs, Lesley Marks and Steve Locke. We talk all about what to expect from markets, both equity and fixed income, for the back half of the year and beyond. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Matthew Schnurr. I'm delighted to have our CIO of Fixed Income, Steve Locke, and our CIO of Equities, Lesley Marks, here to discuss the outlook for the back half of 2024. Steve, Lesley, welcome to the podcast.
Hi, Matt. Thanks so much for having us.
Thank you, Matt. We're excited to talk about our mid-year outlook today.
Excellent. Why don't we dive right into it? Why don't we start off by talking about the macroeconomic level with global growth specifically? Lesley, global growth remains better than expected. What are the reasons behind that, and what does it mean?
Well, I think it really starts with the world's largest economy, the United States. It's really been driving the sustained global GDP growth that we've experienced to date in 2024. Because if you look at almost all other major economies, they're really showing the sluggishness that we would expect from tighter monetary policy. I mean, we're especially seeing that here at home in Canada, but not the US. And really, I think that the U.S. has been the exception from a couple of big trends. The first one being the big fiscal spend that we've seen from the government. And there's been, investment geared towards things like the Inflation Reduction Act or the CHIPS Act. But also there's been many other what we would describe as onshoring initiatives to really incentivize spending in the United States, things like forgiveness of student loans. All of these things have contributed and supported to outsized growth in the U.S. economy. The other really interesting thing that we've seen are big productivity gains, and the productivity gains have obviously also helped to enhance GDP growth. Immigration, one more thing to add on, to pile on, has been supporting the demand that exists with labor. The U.S. economy has a very low unemployment rate, but thankfully there's been an inflow of population that's helped to support all of this additional stimulus spending. And the implications in your question, I would say, is first of all, we expect all of these trends to persist. No matter which administration, we think that both would be very much committed to certainly big fiscal spending, even if they have different views on immigration policy. So we think that that continues to bode well for the economic backdrop in the U.S. and therefore the global economic outlook.
Great. Thanks, Lesley. Steve, maybe I'll turn the next one to you. And Lesley talked a lot about U.S. growth and a little bit about the labor market, but we do see continued resiliency within both of those statistics. And that has led to relatively sticky inflation. All of that has led to a fairly dramatic repricing of where they thought interest rate cuts would be, with 6 cuts being priced in at the beginning of the year. Where are we now, Steve, and what should we expect in the back half of this year?
Yeah, that's right, Matt. I mean, inflation's been the real issue that the Fed has been grappling with. And if we think back a couple of years, we've seen, of course, a sustained and very dramatic set of rate hikes by the Fed and other central banks, including the Bank of Canada, in the context of fighting inflation. So as we've been talking about in our outlooks, the last mile of that inflation fight is going to prove to be the toughest. And we certainly have seen that year to date. Your comment there reflects that in the way that pricing in the bond market is showing the expectations of Fed rate cuts in 2024. Now, think about what happened at the end of last year. The Fed, after all those rate hikes, pivoted to we'll call it more of a neutral stance with a bit of a dovish outlook coming into the year because inflation was coming down. The market got way ahead of that, and we called that out at the time. Those 6 rate cuts that were priced in by the Fed were over the top. We did expect to see some rate cuts from the Fed this year, But clearly, the inflation story and the growth story that Lesley just talked about for the U.S. economy have been a little stronger than expected in the first half of the year, which has caused the market now to reduce the number of rate cuts expected. So your question, over the second half of the year, the market is currently only pricing, about 1.5, just over 1.5 rate cuts. So if you think of a rate cut being 25 basis points or a quarter of a percentage point, the market's expecting to see a rate cut near the end of the year after the U.S. election, in fact. So there's nothing really priced before that. It's an interesting period of time, usually before a U.S. election. What does the Fed do with rate cuts or changes in the policy rate in either direction before an election? There's an idea that the Fed doesn't want to get involved with the politics. They don't want to become seen as being politicized in the way that they execute their monetary policy regime. There's a good argument to say that as we get through the summer, the Fed may not do anything until after the election. Now, September might be in play for a Fed rate cut if we see inflation coming down and if we see any sort of things changing in the labor market in particular that show a slowing growth profile. So that's the way the market's priced today for the Fed as we look through the end of the year. There's a cut and a half or so priced in at the end of the year. Bank of Canada, just to quickly reflect on that, Canada's in a little bit different situation. We've got a very interest rate sensitive economy here and clearly a slowing growth profile relative to the U.S. on the domestic side. And the market's priced in about 2.25 cuts before the end of the year from the Bank of Canada. Again, thinking of a cut as 25 basis points. So we expect to see something in the summer, but we would expect to see the Bank of Canada going first and having to go a little bit more aggressively than the Fed as we look forward through the end of the year.
That's great, Steve. Great context. Maybe, Lesley, back to you. So on the back of the macroeconomic outlook, what do you expect from Fed and Bank of Canada going forward? And probably more importantly, what do you think the impact on global growth will be based on the central bank activity?
Yeah, so I think Steve did a good job in outlining the expectations for the Bank of Canada. I mean, we do expect this year to see cuts at, a slow and measured pace from the Bank of Canada. The Fed's a little dicier. I think you could sort of split on whether you think they'll move once, twice, or not at all. So I think we're still talking about small measured moves here overall, but directionally, we're talking about easier monetary policy. And I think that when you think about the impact on economic growth or global growth, that's generally supportive. Easier monetary policy is supportive for global growth. The relative economic growth trends between Canada and the U.S. obviously necessitate a different pace of policy changes. And so I think that it's, certainly important for the Bank of Canada to support the Canadian economy here. We've seen fairly, divergent paths between Canada and the U.S. And our market is really, we're navigating that. We're trying to really understand whether or not the Bank of Canada has, waited too long before enacting a policy cut when it comes to economic growth. That remains to be seen. But we think that that since we know that both central banks are looking very closely at inflation specifically, we do need to see more supportive data around inflation to get them really behind aggressively cutting interest rates.
Thanks, Lesley. Just talked about the reduction in rate cut expectations. Steve, what does that mean for bond market volatility? Clearly, you think about bond markets benefiting from rate cuts by and large, but with those off the table, what do you expect going forward?
Certainly we expect, and we have actually seen already a reduction in volatility. If investors think about kind of where the yield curve has been, where Fed policy rates have been over the past couple of years, we went through that low yield period for a long time where there was a fairly stable expectations of what the Fed and other central banks like the Bank of Canada would be doing with their policy rate. Now, that changed dramatically as we talked about with the rate hike cycle beginning about 2 years ago. Volatility in the bond market went up significantly at that point. Think about it as more than doubling from what it had been before. So giving a context for the rapid changes by the Fed, and bond market participants trying to figure out, where was this going to land? Like, where was it all going to go through the yield curve? How would that translate? So that led to that level of volatility being much more significant. What we've seen year to date is that volatility has been coming down. Now, this again, translating that back to the policy environment, the Fed pivoted to more of a neutral to dovish stance, and that's been helpful to the bond market in the sense that the volatility of prices in bonds, so that volatility is what we're talking about, has come down. And we expect it to continue to trend down because the Fed, Bank of Canada, ECB are all aligning to rate cut expectations, and the market is more aligned, we think significantly more aligned than it was 6 months ago, to the pacing of rate cuts that we should see from those central banks. So expectations are more likely to be fulfilled. Yields are also higher and than they were before. So this is obviously another thing with the expectations of hikes being done, leveling off of those yields and the potential for them to come down. This encourages lower volatility as well. So all in all, Matt, it's a good story there for bond investors overall.
Yeah, maybe just to double click on that, Steve. You painted a fairly compelling story. So you have lower volatility, you have healthy yields now compared to the last time we had a lower volatility in the bond markets, which with much lower yields. What opportunities are what investors should be specifically focused on within the fixed income space?
I think a good place to start there is to think about, when you're buying bonds, you're getting this coupon and a potential price return with that. And so when we think about where yields are today, on a nominal basis, look very attractive. In other words, we've seen a rising yield curve for 2 years, and that's put more yields in the hands of investors who are looking at the bond market today. So not only are you getting a good yield, but you're also getting, with the rate cut potential, some expectations that yields may be coming down in the future. So that produces a little bit of a price pop that goes along with the yield you're investing at. So you get a total return that can be potentially higher than the starting yield. So that's a good prospect for investors. Now, we're not going to get too far ahead here. We need to see yields come down, and we do expect that they will, but not necessarily dramatically. So it's a good starting yield with a little bit of a potential tailwind. But the other thing to think about for investors is that inflation has come down. So when we think about where those yields are in the bond market today, they are significantly above the rate of inflation. So you're getting a real yield, which is we call it an inflation-adjusted yield in bonds. And so when we think about it again from a recent history, getting 2.5% real yields on many government bonds is a very attractive proposition from a historical perspective for investors. So that's a good story again. And then lastly, we can think about areas of the market that we think provide additional yield on top of that, such as corporate debt, as having some really good prospects for investors today to take advantage of, because you're getting not only good real yields on the underlying component of that, which is the government yield curve, you're getting a credit spread on top again to give you a nice total return package, total yield and total return package from especially higher quality corporate debt today. So, where we're investing, Matt, across our portfolios, and we would recommend that, clients think about the fixed income market for all three of those aspects as a good medium-term prospect for investing today.
It's great context, Steve. I'd love to shift the focus slightly and talk about sustainable debt. We continue to see record-setting levels of issuance within sustainable debt. Why do you think that is? And any comments on the asset class in general?
For sure. I mean, we're seeing a number of really nice trends within the sustainable debt market. I'm looking at some data from April from global issuance of sustainable bonds. There's different types of ESG labeled debt, sustainable type investments in the bond market. We've seen some record issuance in some areas, and actually some growing issuance in areas. So you get a diverse number of types of investments in the bond market you can take advantage of. April, for example, gave us a record level of social bonds issued. So we have the use of proceeds going toward types of ESG, the S, the social components of what governments and companies are looking to do to increase their sustainability over time, and how they engage in their processes, how they engage in energy transitions, how they engage in social issues, in their various jurisdictions. So it gives investors a lot of potential to look at different use of proceeds and really think about how they include that in their portfolio. The things that are important to them as they think about things outside of or alongside of the investment returns that they're generating. We've had obviously very interesting few years in the way that ESG and sustainability has become a very hot topic and at times cooled, especially in certain regions politically. But when we look at it from a global macro perspective, across the world, there's an increasing interest in thinking about the use of proceeds and thinking about transition in the way debt is being issued. And debt will fuel a lot of that, Matt. So we think about converting various types of power generation to more sustainable fuels. That process requires debt investment. And so we like the ability to choose from a wider array of options in the debt market today, and investors should look at that.
Makes a lot of sense. And certainly at Mackenzie, we've been very excited about this energy transition and both the implications for fixed income as well as equities. Lesley, maybe I'll turn it over to you to comment on the equity side. We've seen record issuance of sustainable debt. However, equities a little bit more bumpy, I would say, year to date in your history. I'd love your comments on that.
Certainly. Well, we described it in the mid-year outlook piece as the great energy transition in transition. So a bit of a play on words. It speaks to what you've mentioned around greater volatility in some of the subsectors that are plays in the energy transition. But make no mistake, we still believe that this remains a compelling theme for investors to incorporate in their portfolios. And there's no question that governments and businesses around the globe continue to emphasize its significance when you look at their policy and where they are investing. I mean, the Inflation Reduction Act is a great example. There are many green energy proposals within that act. But, like any transformational trend, the trajectory is not always a straightforward and upward path. And when many of the transition measures that we're living with today were adopted, it was in the context of a different world, lower inflation. Obviously, costs were lower as a result of inflation and generally lower interest rates. So that's created a bit of a shift in the economic criteria for investment. When you have higher costs and higher interest rates, that's really impacted project economics. And then additionally, what we've experienced over the last year and a bit has been greater geopolitical conflicts. And the reason this is important is because this has also diverted fiscal resources and attention away from the energy transition efforts. As we've seen, defense spending for governments is taking precedence over other expenses. And then I think the last point is that consumers are also experiencing some fatigue due to the inflated costs associated with supporting the transition. So there's been a confluence of events that have made this a bit of a rocky ride this year. But we view these as really temporary headwinds. And we think that most people in the world remain very much aware of all of the converging challenges of, economic growth, increased prosperity for an economy, increases resource consumption, for example, in the context of resource scarcity and ecological constraints, such as the obvious, climate change. So we think that there are still adjacent opportunities for efficiency technologies in things like transportation, water, agriculture, building sustainable infrastructure, and capital goods. And this will all support demand in addition to what we've thought of as conventional green economy plays like solar and wind, et cetera, into also a greater focus on traditional materials. So the materials that are required to build many of these projects, and including all of the infrastructure that comes with the onshoring or friendshoring trends that I mentioned in one of your previous questions. So things like copper, nickel, catalytic metals, even lithium, all of these raw materials or traditional materials, the supply chain needs to keep pace with the increasing focus towards an electrified economy.
Great context and makes a lot of sense. I'm curious just to come back on that. Steve had referenced earlier upcoming election and potentially some impacts on that. This seems like an area where there could be the largest differentiation or a large differentiation between the posturing from the Biden group and the Trump group. How important do you think the election is to this specific issue? And then just broaden out in general, how important do you think the U.S. election is to markets?
Yeah, it's a good question. And what I will start with is the last part of your question, which is, how important is this in general to markets? If you go back in history and look over the last at least 100 years, probably more, you can study each of the term years for a president. And the election year tends to be generally a very positive year, no matter whether it's a transition government or the same government, and particularly if it's, a Democratic government to a Democratic government or a Democrat to a Republican government, those tend to be good investing environments. So let's just start there, that election years have historically been very good for equities. And if you look year to date, this year being no exception thus far. So we like the backdrop. Certainly an administration wants to focus on, and they know their ticket to re-election is a strong economy. So that we'll just park that. The earlier part of your question was about the energy transition and how sectors like that could be impacted with respect to a certain outcome for the election. And I think that's a very key point because we make statements like election years are good for equities, but you need to really double click into that statement and look at what sectors will benefit from the different administrations, because I think there are some distinctions, and probably the most important is energy. And obviously, both administrations have a very different view towards green energy versus fossil fuels. So if you take this in the simplest terms, we think that under a Republican administration, fossil fuels certainly benefit. There will be much looser regulation, much more incentive to spend to develop fossil fuel reserves, et cetera. On the other hand, we think under the current administration moving to a second term, the Democrats, Biden administration will continue to be overall positive for green energy, energy transition, all of those themes. So there definitely is a dichotomy expected in performance with a certain election outcome.
Great. Maybe we'll just stick on current market themes. And certainly the big one this year could be summed up with one stock, which is NVIDIA. The rise of NVIDIA over the past 12 months has been extraordinary, clearly on the back of excitement around generative AI. Maybe two questions rolled into one on this one for you, Lesley. Gen AI, what do you think the prospect is on this investment opportunity? How much has been priced in? Is it overhyped? Is it a redeal? And then secondarily, there is a component of generative AI that relies on lots of power production and use of power. How much of that is at conflict with sort of the energy transition?
Why don't I start again with the later part of your question, because it's a good segue from our discussion that we just had on the energy transition. And the short answer is that this artificial intelligence revolution is certainly poised to strain an already overburdened global electricity system. And just in the simplest of terms, generative AI searches consume more than 10 times the energy of traditional search methods. So just, your run-of-the-mill Google search, for example. And when I say more than 10, it could be up to, 20 times. So this really highlights, in our opinion, the associated risks of decades of underinvestment in power infrastructure. And that really segues into the discussion around the opportunity that we're seeing evolve in the energy transition. So we're very optimistic about the immense opportunities that exist in the energy transition, and the AI revolution really just adds to that enthusiasm. And this obviously impacts various, asset classes and sectors of the economy. I mentioned the underinvestment in the electricity system. So obviously infrastructure, industrials, and I talked about traditional materials also being beneficiaries. So that's the later part of your question. Now, the thing that probably everyone really wants to hear more about is the early part of the question, which is about, is this overhyped, and the investment opportunity. And in my experience studying various major technological shifts, we do tend to see a path of a bit of, overhype, and then there's sort of a reality check that sets in. Now, a lot of the focus has been very much targeted on some of the larger tech giants like NVIDIA and Microsoft, for example. But I think what we are looking at collectively across Mackenzie is where are the opportunities that go beyond these big, obvious tech giants. And we see lots of opportunity within, software, hardware, services, enabler industries that really underpin AI's transformative journey. And so we're very excited about the broadening of opportunities, even though we recognize that today the market is very much focused on some of these big behemoth companies that are fairly obviously benefiting from the gain in AI applications.
That's great. You talked a little bit about the enablers. In my mind, I think sort of companies using this technology as well, who maybe aren't directly involved, but just to improve their business and et cetera. Can you elaborate more on the impact of technology and how it can impact economies overall?
Well, I think that one of the most important ways is thinking about productivity. So we acknowledge that the US has experienced extraordinary productivity. If you look at Canada on a per capita basis, we haven't had the same benefit to our economy. And so thinking about technological advances and implementation across the economy, whether it's in healthcare, finance, logistics, entertainment, you name it, any industry, if we can really wrap our arms around implementation of some of these technologies with a view of return on capital and investing to get a return that is expressed through increased productivity for a corporation, and that rolling up to an economy overall, to be able to enhance productivity can be a very powerful way to grow GDP. And in the face of, especially if you think about Canada, which demographically has a more mature, and as many Western world countries do, a maturing demographic, if we can harness the power of AI to increase productivity to offset the impact of the demographics in our countries, we can all be better off with stronger GDP growth.
Thanks. Steve, we've spent the last 30 minutes or so just going through various parts of what has happened in the previous year, a few sort of predictions about the future, but let's put a specific pin in it. And I'd love to get your view on what investors should start thinking about for fixed income and various sub-asset classes going forward.
Yeah, for sure. And, building on just the last comments there from Lesley on the AI revolution that's happening, the productivity enhancements are also things that will come in over a long period of time from the increased use of the technology. But one of the benefits that could be that we have a disinflationary component to that economies feel. And so again, leading off here in terms of an outlook and what to think about within fixed income, as we talked about earlier, with inflation that's been high coming down and a potential for rate cuts, again, we think that bond portfolios here should be set with a little bit more exposure to duration, or kind of term to maturity investing should be pushed out a little bit. And so that's something that certainly we've done. Particularly this applies, we think, to Canada. As we talked about, the Bank of Canada is more likely to have to cut rates and be a little bit more aggressive given the slowing domestic components of our economy that are so interest rate sensitive. So to start with, when we think about inside the fixed income portfolio, a little bit longer term to maturity is important. And this, I think, is something investors should really reflect on, because there's cash on the sidelines. People have been very well rewarded to be in cash with the higher yields available from money market and other even deposit based holdings in their portfolio, those things will start to change, and the reinvestment rates there will come down quickly. And so investors would behoove themselves to move a little bit of that money out on the yield curve in form of a bond type holding, bond fund, ETF, et cetera. So that's the first and foremost. We're setting our durations a little bit longer, especially in Canada. Beyond that, when we think about the things I said earlier, high quality fixed income is offering a reasonably good spread for investors today. And so we think about those real yields available with inflation coming down, plus the credit spread. This is a good moment for investors to think about investment grade corporate debt. We hold that overweight, and we're recommending a continued overweight in that very defensive area of corporate credit. Beyond that, within the high yield basket, there's some reasonably good yields available here. We're talking about high single digit yields on high yield bonds as a marketplace yielding over 8%. And the leveraged loan market as well, or floating rate loans, again, sort of a cousin to the high yield bond market, yielding a little over 10% as a market. Now, within that, there's different qualities of investments. So we would say that at this point of the cycle, corporate fundamentals remain strong. However, we want to make sure that we stay away a little bit from the most speculative grade of the below investment grade type issuers. So within the high yield bond and loan markets, we would stick to the higher quality zone there. And so you're able to pick up, though, in those types of investments today, 7 to 8% yields. And that's really, really attractive in the proposition of stable interest rate markets and potential for them to come down a little bit. So those are the areas to think about in the sub-asset classes. Again, a little bit longer duration and remain overweight in high-quality credit is the message.
That's great, Steve. Lesley, maybe turning to you, same question, but on equities, and maybe steer us to specific geographies that you find appealing or not.
Yeah, so we've talked a lot about the looser monetary policy conditions that we expect. We think corporate earnings growth is still very much conducive to equities. And we expect to see this really broaden out the more narrow market rally that we've experienced. And we have seen some indications of a broadening out of the market rally. So we think that those trends all continue. And that's a very good backdrop for equities. When you think about the different geographies, we currently have a neutral view across the US, Canada, international, and EM, but this should not be taken as a lack of enthusiasm towards these regions. We actually think that investors should have representation across all of the regions for different reasons. Of course, we continue to like the US because we see that big fiscal trend that we talked about continuing under any potential administration, and that's going to support the U.S. economy more broadly. We also like the exposure that you can get primarily in the U.S. to the AI evolution and technology trend that we also talked about in our themes. But then turning towards some of the other economies or markets, we like Canada, for example, for its attractive valuation, nice dividend yield, you're paid to wait, and the materials exposure, which we think is imperative to support both of the key trends we recommended today, on the AI side and as well as the energy transition. So we think that despite some of the trade, I would say rhetoric fears around a potential Trump administration, we're still the best partner for the U.S. And so that will create a lot of noise and maybe a bit of chaos, but we think overall Canada is well positioned. I guess then thinking about the other markets, when we think about international, that breaks us into Europe and Japan. Europe will also benefit from what we expect to see as looser monetary policy from the ECB. And we like Japan for a more secular growth story related to a whole bunch of more shareholder-friendly policies that are making their way through the Japanese market, a broadening out of equity ownership for Japanese individuals, and just more interest from foreign investors in Japan and the Japanese economy. And then maybe just closing on emerging markets. The emerging markets ex-China have been certainly beneficiaries as companies have looked to diversify their supply chains. And we think that trend continues. But on the other hand, the green shoots that we're starting to see in China have us more interested in China. And although we acknowledge the weakness from still sustained weakness that we expect from the property market, which is really creating a lot of downward pressure for the Chinese economy. And that's not going to go away anytime soon. We could have a little bit of a consumer-driven rebound because consumer sentiment has been quite weak in the region. And as I mentioned, we're starting to see green shoots. We're starting to see more conducive policy to economic growth in the area. And this is the second biggest economy. So we like the outlook for emerging markets as well. So that really takes us around the world with equities, generally an upbeat, positive outlook.
I'll say in general, sounds like the overall theme that I'm taking away is just get invested, move out of cash, find something to invest in, lots of opportunities in front of you. Steve, Lesley, thank you for spending the time with me to go through your mid-year outlook. I really appreciate it.
Thanks, Matt.
Thank you, Matt.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.